That you should have learned it in MGF B10. All right? So let's say this is a 3-year ordinary annuity. So if it's a 3 years ordinary annuity, then you have C, the cash flow at this point. Right? But an annuity deal means you have cash flow at here. So this is the cash flow of an annuity deal, a 3-year annuity deal. So I believe in B10, you learned 2 methods to calculate the present value of an annuity deal. The first method, which is not recommended in this course, is you calculate the present value of this payment and the present value of the remaining 2 present value, right? Cash flow. So this is C plus C times present value and unit factor for the discount rate and for 2 periods. Alright, so that's one way to get the present value of an annuity deal. Now the recommended method actually is the C times present value and unit factor R3 times 1 plus R. So this is the recommended method. Alright, so basically this equation is to assume that, well, I apply this formula. Assuming there's 3 payments. So when you apply this formula, you get the present value at year, this is year 0, this is -1. Right? So I told you in the first class, when you apply the annuity formula, growing annuity formula, and perpetuity formula, growing perpetuity formula, the present value you get is always 1 period before the first cash flow. So now the first cash flow occur at time 0, right? At time 0 right here. So when you apply the annuity formula, you get the present value 1 period before, which is right here. So, but you want the present value at time 0, so that's why we need to compound it back to time 0. Now, the reason why I suggest you to use this approach is this method works for annuity deal, perpetuity deal, growing annuity deal, growing perpetuity deal. That means no matter what kind of cash flow, as long as they happen at the beginning of the period, you just multiply by 1 minus 1 plus R, then you will get the answer. Now if you use this method, if they are growing annuity, then you have to adjust the C, because you have C here, you have C1 plus G, and C plus 1 plus G to the power 2. If it's a growing annuity deal, then you have to adjust this amount. If you just use C, you get the wrong answer. Alright? But using this approach, I don't care. I just use this, the first cash flow. Apply the present value, that's 1 period before, compound 1 period. It's always work. So even though it is a perpetuity, but happened at the beginning of the period, at the end, just multiply with 1 plus R. That's it. As simple as that. Alright? So that's why I recommend you use this approach, because it will always work and you will never make mistake. But using that one, you may sometimes make mistake because you have to adjust the cash flow. Okay? Alright? So this 1 plus R in the formula is to adjust it for the payment occurring at the beginning of the period. Right? This is a typical assumption we use in this course unless the question says otherwise. Right? Now, since you lease the asset, you also lose the CCA tax share, and you lose the present value of the salvage value, and you lose the TLTL if there's any. So sometimes this may be 0. So don't assume this is always the case. Right? Depends. Remember the little table we have. Right? There are 4 possible outcomes. 2 of them CCA recapture. 1 is terminal loss. The other one is nothing. So if the last one occur, then this term will be gone. You don't have this term here. Alright? Now, if you calculate the NPV of the lessor, then you can use the same equation, but you just have the opposite sign. Because the cash flow of the lessor and the lessee, they are just opposite of each other. All right, because the lessor, they have to pay Z0 to buy the equipment and give it to you. And then they receive the after-tax lease payment for the next N year at the beginning of each period. And they can claim CCA tax shield. They own the asset, so they receive the salvage value at year end. And they will have terminal loss or CCA recapture. Yep.
Where it says like the L times 1 minus tax shield times PVAS times 1 plus R, is that the present value of the lease payment?
Yeah, that's the present value of the lease payment. Because they are happening at the beginning of each period, so we multiply by 1 plus R. Okay? All right? So lease actually is an easy question. Trust me, try it. Question number 3 is very straightforward, easy one. Now, so if I use the table, right, just discount everything, I have negative 376.28. Now, if I use the formula, I get 376.27. This is just due to little rounding, but it should be irrelevant. All right? Now, the problem is, yeah, I'm fine if they assume happening at the beginning of each period, the tax shield. But the problem is, they move on to the question, say, oh, hey, what happened? What is the NPV of this leasing if the salvage value is $1,000 at the end of year 5 and the asset class continues, right? And then they use, this time in the textbook, they use the CCA tax shield formula to calculate everything, just using well, basically they're using this one, using all this formula, right, to calculate the NPV. Now they get 810. Now the problem is, doesn't make sense. This number doesn't make sense. If you look at it, without the salvage value of 1,000, the NPV is 826 negative. With $1,000 of salvage value, the NPV is only $16 different. Now even the asset class continue or asset class terminate should not have a major difference, because if the asset class terminate, you have terminal loss. If the asset continue, then you just continue to claim CCA for that. All right? The only difference here is you do not lose the $1,000. All right? So the difference should not be just $26. Doesn't make sense to me. Right? Even $1,000 at the end of year 5, when you discount it, there's no way that's roughly equal to only $16. So we know this is not wrong, but just inconsistent assumption. All right, just inconsistent assumption. Now, if you do not believe me, just look at this table. I prepared this table. All right. Now, this is the one they use in table 22.2. All right, negative 826. Now, this is the one that when they use the CCA tax shield formula, they get 810 point something. I believe this is, let me just double check. They have 810.64. All right, the difference is due to rounding. So that means in the first part, they assume the tax shield is at year 0, year 1, year 2, year 3, year 4. Now, when they use the formula, they assume year 1, year 2, year 3, year 5. All right, and this is the salvage value, and this is the $13 the CCA tax shield forgot. Because we know that the UCC is equal to 1,037, right? And the salvage value is only 1,000. So that means there will be $37 continue to be depreciated. So when you calculate the present value, that's equal to 13. So if you look at this formula, actually right here, right? If you look at this calculation, it's just 1,037 minus 1,000 times the CCA tax rate times corporate CCA rate times the corporate tax rate, and divided by K or discount rate plus the CCA rate. Right? So that's why it's 13. Okay? So that means they're using this and this. Now, if they use consistent assumption, that is, hey, let's assume all CCA tax shield happen at the beginning of the period. Now, the CCA, the NPV should be negative 1,261. So that means the difference should be about 400 something. Now, this is the same. So this is this calculation is I assume all they happen at the end of the period for CCA tax shield. Now you can see the difference is about 400 something. Alright? So that means I will say the tax book, when at the beginning they assume this, but later on they assume this. Alright? To be consistent, they either use the first top one, this 2, or they either use this 2. Alright? Right? So in this course, I always assume this case. That is, we stick with the CCA tax shield's formula. Assuming the CCA tax shield happened at the end of the period. Yeah, I did not write to the offer and make a recommendation because this is not good. I did it once, many years ago. I sent it to offer of, well, the CFA curriculum, they have a problem with a tax calculation, all right? And when I first looked at it, I know this formula is wrong, doesn't make sense to me, all right? So I go online and look for those CFA curriculum forum, and a lot of CFA members try to justify that equation. I know they are all BS. They did not know what they are talking about, all right? And then the offer next year, they change the equation. They change the equation. And then the forum said, oh, this is the correct one. But even worse. And then next year, they change it back to the original equation. But it's still wrong. All right? And Jason actually asked me, hey, why don't you send me a letter saying well, making some recommendation. So I was very polite. I said, well, this is my opinion. I suggest to do that. And then what happened next year? They removed the topic. They don't want to admit that they are wrong, right? So even CFA, don't believe textbook, don't believe textbook, don't believe any curriculum. People always make it today. Don't even believe me. All right? So what I said now is, I believe they are correct, they're right. But maybe 10 years down the road, someone proved this is all garbage. I don't know, all right? Use your own judgment. Use your own judgment. That is learning. That is, you should criticize everything. Criticize everything, right? Okay? So, but this one, I'm not saying they're wrong, but they should use a consistent assumption. All right? So in this course, we always use this one here. Okay? All right, so now is, does leasing ever pay? So they look at the base case. That is, if the lessor and the lessee, they have the same tax rate, they have the same interest rate, then it will be a zero-sum game. Right? Because their cash flow, the numerator, the cash flow, they are just the same but with different opposite sign. So if the discount rate, which is the after-tax cost of debt, they are the same, then of course, this positive, this must be the same amount but negative. So there's a zero-sum game. That's no saving. All right? The only case there's a saving is if they have different interest rate or they have a different tax rate, then they can minimize the payment to the CRA. Now, what happens is they can split the saving between the two parties by lowering the lease payment or increasing the lease payment a little bit. Right? So this is their bargaining power. Okay? So the question now is, hey, what is the break-even lease payment? That is, what lease payment will make the two parties have zero NPV? All right? So if I assume they are happening at the end of the period, I find that this is 4,858, and according to the textbook, that is, they assume the CCA at the beginning, that's 4,688. Now, this calculation is very simple. Basically, again, using this equation. So what you need is just set your NPV equal to 0. Instead of calculating NPV, this time set this equal to 0. You know the cost of the equipment, $20,000. You know the discount rate, 0.066. You can calculate CCA tax shield, right? This is all information is all known, given. You know the salvage value. In our example, this is 0. Right? You also can calculate the TRTL. The only missing variable is L. So this time you solve for L so that your NPV equal to 0. Alright, so it should be a straightforward calculation. Now with Excel, it's easy. So the same thing with Excel, I can use what if analysis. So I strongly encourage you to try at least once in your assignment. Right? Do it manually. So if I solve it, this one is easy. So what I need is just use what if analysis again. So what I want is this one. That is, I want NPV equal to 0 by changing my lease payment right here. So if you do it, yeah. So that's 4,688. And if I assume CCA tax shield happens at the end of the period, what is the lease payment that will make the two break even? So the same thing, I just want to go with what if analysis. This time I want this 827 equal to 0 by changing my lease payment, which is this one. Yep. So that's how I. Yep, that's how I get 4,858. All right. Well, if you do it manually and you want to double check, you can use Excel to do it. But please, at least try once to solve this manually. Okay? Now this week, the quiz is to calculate NPV of a lease. One is for the lessee, one is for the lessor. But I simplify the equation. That is the CCA tax shield, they are given. You don't need to do calculation. All right? They are given. I just want to make sure you know which one is plus, which one is minus, so that you don't make mistake in your assignment. Right? I want everyone to have an assignment 100%, honestly, right? Okay, because if you do 100%, well, under the assumption you do your own work. Okay, under the assumption you do your own work, not copying others. Okay, I want everyone to get 100% because you know how to solve those problems, then you would not have trouble in exam. Okay. So I want to pass everyone, but this is a dream. I don't think I can do it because some students, I don't know, they don't care. Some students did not come to class, did not submit assignment, but I don't know. I see those names term after term. They're always there, they always fail, and then I don't know. Okay. Now the reason for leasing. Now there are several good reasons for leasing, but there are some bad reasons for leasing. One good reason for leasing is tax can be reduced. Yeah, that's correct, right? So if you have different tax rate, different discount interest rate, then we can save tax and we can share the benefit between the two parties. Yeah, that's good. Now, second one is you can reduce some kind of uncertainty. Yeah, especially this is a new product. All right, if you buy it, you pay the full cost, and you find out, oh, this is not good. This is a bad product, or the quality is poor. You may not be able to verify or observe the quality at the beginning. It takes time to observe the quality of the product. Then you probably want to lease it. You just have an operating lease first, all right? And maybe you buy a used one, let's say, after you think this is a good product, all right? To reduce the uncertainty about the quality of the product, okay? So that's why people lease. Now, another thing is sometimes the transaction costs matter. Think about it. So why people lease an automobile, right? So why people lease automobile? First of all, I don't know about the quality of the car, right? Since they offer me a 0%, zero interest rate, so why don't I just lease it, all right? And assume the same price. But of course, if you pay cash purchase, you may have $1,000 discount. Okay, but if interest rate is matter, say for example, I pay 0 interest on my lease, all right? And if you look at the past few years, interest rate 4 or 5% GIC, I actually make more than $1,000 the initial discount. Okay, so in this case, about transaction cost. If you buy the car and you don't want it, let's say after 3 or 4 years, now you have to sell it to another party. So that means you have to find a buyer. If you sell it to a used car dealer, probably the price is much lower than its fair market value. But if you want to find your own buyer, it will be costly, time-consuming, and also risky, right? You know it. Several years ago, a gentleman wanted to sell his truck and got killed Yeah, that's true. All right, because there are bad people out there. All right, so they wanted to have a test drive and they drew away and then they killed the gentleman on that day. All right, so that's the transaction cost. But if you lease it, then you return the car to the dealer. They have a used car department or second-hand department, right? Or P-owned, what they call it, they have a better name, they call it P-owned department. So they have a lot of customers, right? They have the showroom, they have all the service, everything. So the transaction cost for them will be much lower in that case, all right? So that's another reason why leasing can save some transaction cost at the end of the term. All right. Now, bad reason is some people say, okay, because using leases, I can save, can have a better reported accounting income. But don't forget about, no, the accounting rules say, no, this is not allowed. So if you have a lease, you have to capitalize it no matter what, right now. All right. Now, even before the IFRS 16, when we have the IAS 17, or even long time ago. Now, analysts actually will undo this. The analysts look at the financial statement and they would look at the footnotes and they find, okay, they have several operating leases. So what they do is they just convert the operating leases into financial lists and adjust the reported net income. Especially if you want to calculate the economic value added of this company. All right? Or residual income. We call it economic value added, EVA. All right. So when you calculate EVA of a company, you have to adjust those. Even though they report it as an operating leases, you have to convert it into a financial list and report the income. All right. So that means analysts, while they are well trained and they have education in finance and accounting, so they can undo whatever you did in your financial statement. All right. And the last one is saying, okay, leasing is 100% financing. No, that's not true. If you have a lot of leases, your creditors, the bank, they also know that. They look at it, they say, okay, you have a lease payment. So in the future, if you run your operation, you have to make those payments. They consider this as your debt. All right, so you will adjust your debt to equity ratio when they determine whether they want to lend you money. Right? So that means this is not a good reason for leasing. Okay? Now, reservation and negotiation. So as I said, if they are the same, then there will be no difference between the two. But if they have different tax rate or different interest rate, now the two maybe they have a different break-even lease payment. All right? So our job now is to try to find the smallest lease payment the lessor will accept, or the highest lease payment that the lessee will pay. Just how much the lessee is willing to pay, and how much the lessor is willing to accept. So if the payment, the lessee, this is the maximum they are willing to pay, and this is the maximum, or the minimum the lessor willing to accept. Now, if that's the case, you have a deal. So anything in between, that's a deal. Both would be better off. But if the maximum lease payment the lessee is willing to pay is lower than the minimum lease payment the lessor is willing to accept, then there will be no deal. All right? So now what we want to do is we want to find out what they are. So in the original example, there will be a lease only the case assume, okay, let's assume the lessee paid no taxes. All right? So assume for some reason the lessee, they have some loss carry forward, or they have some investment tax credit, they have other tax shield. So they don't have the CCA tax shield. Then what will be the maximum lease payment they are willing to pay, and what is the maximum lease payment? Now these two, 4,858, 4,688 will be the one that we have here, exactly the same, just different assumption. Right? So even though the cash flow, they are for the lessee, but still work for the lessor. Right? Because they have the same rate right now. Okay, so NPV is 0. But now if the lessee, they have 0 tax rate in our example, So they mention now, let's assume the lessee, they don't pay any taxes. So that means the tax rate is 0. So now what happened is, if they don't have any tax payment, so you can either use any one of them, doesn't really matter, the same. So this is gone, 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 because there's no tax shield. And this is also gone. Since the tax rate is 0, if you use the CCA, present value of CCA tax shield formula, it's gone. And this TLTL also gone, right? Because when you put the 0 tax rate in it, they're all gone, all right? So now, and the discount rate, not 6.6, 11%. Because the tax rate is 0, all right? So now, again, I want to find out what's the lease payment. What is the lease payment? The maximum lease payment the lessee is willing to pay. Well, you can solve it manually, it's easy, it should be very easy. But I'm using Excel, so now I want this equal to 0 by changing my lease payment. So 4,875, which is the number I have right here. Alright? So if the tax rate is 0, the equation becomes very, very simple, because most of the term will be gone when you apply TC equal to 0. Alright? Alright, now let's look at this example, this little exercise. So this company, so this is very similar to your assignment question, right? So Second Inc. either can buy a new equipment for $250,000 or lease it from a good list, which is a leasing company. The lease term requires Second to make 6 lease payments of $55,000 at the beginning of each year. Now, Second does not expect to pay taxes on the foreseeable future. So the effective tax rate for the lessee, the Second Inc. is 0, because it has a large tax loss carry forward. So Good List, the leasing company, they pay 35% tax and they have a CCA rate of 30%. Now interest rate is 8%. All right. Again, don't ask me what's the interest rate for Second, or if the interest rate is given at 8, that means they both will have the same interest rate. All right. Okay. So the question says, okay, assume the asset class N at the end of year 6, and the equipment has no salvage value. What will be the NPV of the list for Second? What is the maximum lease payment Second is willing to pay? What is the NPV of the list for Good List? And what is the minimum lease payment Good List will accept? And then the question move on and say, calculate the maximum or minimum lease payment if the asset class continue with the UCC is positive. Let me see CLTL in this case 0. And the residual value is $30,000 at the end of year 6. All right. So now if you look at it, so this one is extremely simple. First case, the lessee, the tax rate is 0. So now the relevant cash flow is, if they lease it, they save $250,000 at time 0. So that's a cash inflow. But they have to make a $55,000 of annual lease payment, and the interest rate is 8%, and the tax rate is 0%. So therefore, the after-tax cost of that is also 8%. Right? Before tax, after tax, both are 8%. And they are for 6 years, and I multiply by 1 plus the discount rate to reflect that this is an annuity deal. Right? So in this case, no tax shield. You don't need to multiply by 1 minus t. Even you do, it's just equal to 1. Because 1 minus 0 is equal to 1. And the CCA tax shield is always 0. If you look at the formula, when when t is 0, O will be 0. And the salvage value is 0, so therefore we don't need to include it. TRTL is also 0 because the tax rate is 0. Alright? Now to find the maximum lease payment by the lessee, so what we need is just replace the NPV by 0 and calculate L. Right? So this is just a factor. You can use your calculator and find it, and you can easily solve that. Well, the lease payment will be $50,073. All right. Now, part C or part 3 is to calculate the NPV of list for the lessor. Now this time the asset class terminate, all right? And so we calculated UCCN. Now in this case, we have to assume it is the only asset. Otherwise, you cannot find the UCCN. There's no information from the question. So therefore, it implies this must be the only asset in the asset class for the whole time period of 6 years. So when you do the calculation, we find the UCC should be 23,109. Right? Now, this is the after-tax interest rate because the tax rate is 30%. So the discount rate for the lessor should be 5.2%. All right? So now you use the CCA tax shield formula. Since this asset class terminates, so we always use the UCCN in your X calculation. All right? So this should be 71,331. And then the terminal loss is, now the service value is 0, the UCC is 23,109, so this is your terminal loss, and you multiply by the tax rate, so this is your tax refund due to the terminal loss, right? And you discount it, find time 0 value, 5,967. Okay, so now NPV 16,975. Straightforward calculation. All right? So you can see from this calculation, for lessor, their cash flow is the same as a typical capital budgeting problem. This is investing decision. As a lessor, I invest in this machine. I lease it out, I get this revenue per year. I can claim the CCA tax shield. I get the terminal loss. Okay? Now, last part is to calculate the minimum lease payment accepted by the lessor. So, same thing, you just have used the same equation. Instead of 55,000, you replace it by L, which is our unknown, and you set your NPV equal to 0. All right? Okay? Now, part B, so this time, part B, you just want to calculate your minimum payment, maximum payment. Now, one thing is, you don't need to do most of the calculation again, right? You don't need to, because now the asset class continues, and it has balance positive. So that means the UCCN must be greater than the service value of 30,000, because it's your given. The service value is 30,000, and the UCC is positive. Right after that, so therefore the UCC must be greater than 30,000. So therefore, in this case, we can just use the minimum of the UCCN, which we know is greater than 3,000, or the service value, or the original cost, 250,000. So therefore, X is equal to 30,000. All right, and so now what we do is this is for the lessee. So same equation. If you look at it, same equation. But this time, we just have the service value. That's it. So you just include the service value in here, and you find, well, this time 46,000. All right? And now for the lessor, the minimum amount they accept is 45,000. It's the same thing. Everything is the same, right? You just calculate this one here, and now we don't have TRTL, so don't include TRTL. Students make mistake is sometimes you just forget. Okay, I just copy the same formula. Using the whole thing right here, using the whole thing right here, right? But don't forget, we don't have this TRTL because the asset class continues, but we have a service value, which is this one. All right, so we get 45,830. All right, so any questions? So lease should not be a big problem, should not be a difficult topic. And you want to go, or we want to talk about futures and forward? Oh yeah, question.
What's the difference between the part that's in the L-min that's calculated in part 4 versus the part that's in?
What's the difference between the L-min?
Yeah.
So now, for this part is the asset, now for this part 4, the asset class terminate. And there's no service value. But in part B, they changed the question a little bit and say that, well, the asset class continue with a positive UCC, and the salvage value is $30,000. Right? So you need to make adjustment accordingly. So that's something you need to do in your assignment and maybe in your final exam as well. Okay, so everyone is packing, so yeah, I'll let you go. Okay. And so next week we'll talk about futures, forward, and options. Now, if you're from other section, please pick up your
I'm reading the next book right now. For fun. I mean, this is up your alley. This is what you like to do. What are you kind of doing? The one people that every person hates on? That's what I would think. Probably HR or supply chain. Supply chain is all. HR though. I kind of find it interesting. You like hiring clients? I mean, I would do it. The hiring firing. Compensation benefits, or like I can't specialize off the bat.